Welcome back to the deep dive, where we take a stack of resources, cut through all the complexity, and really try to distill what matters.
And today we are diving into a big one, Polkadot, or DOT. It's a project that's positioned itself not just as another blockchain, but more like the foundational plumbing for, the next generation of Web3.
And it seems like you've tuned in at the perfect moment. Polkadot just saw this pretty impressive surge. I think it was nearly 10% in just 24 hours.
It was, as of January 14th, 2026, a huge jump.
A 10% spike that just blew past the rest of the market. That definitely deserves our attention. But before we get into the why, for anyone who isn't, deep in this space every day, what exactly is Polkadot at its core?
Okay, so Polkadot is what they call a layer zero meta protocol. And that's a really crucial distinction. It doesn't really process transactions itself in the way you might think.
Right.
Its main purpose is to provide the security and the communication framework that connects a whole network of these specialized independent layer one blockchains. They call them parachains.
So its job is to connect other chains.
Exactly. The big vision is to let people transfer any kind of data or asset across this whole ecosystem, not just tokens.
And this was built by some pretty heavy hitters, wasn't it?
Oh, yeah. Founded by Ethereum co-founder Gavin Wood, along with Robert Habermeyer and Peter Sabin from the Web3 Foundation. So, you've got pioneers of the space building what they see as the next foundational layer.
Got it. So our mission today, we're going to unpack this recent market momentum, dig into the pretty sophisticated architecture that makes it all work, and then look at its unique governance model.
And then we have to look at the other side, the, let's say, cold economic realities and some of the contradictions that critics point out.
Exactly. Let's get into it. All right, let's start with the money. That 9.65% rise on January 14th was, well, it was remarkable. It outpaced the broader crypto market by more than double. So what was the perfect storm that made Polkadot outperform so dramatically?
The sources all seem to point to this confluence of three distinct factors hitting all at once. The first one is just the market tide. Bitcoin broke and, more importantly, held above $95,000.
The classic "a rising tide lifts all boats" scenario.
Pretty much. When Bitcoin finds a stable floor that high, capital just naturally starts rotating into what they call high beta altcoins like DOT. And we saw proof of real demand in the trading volume. It spiked something like 120.97% in 24 hours.
Wow. So the market provided the fuel, but you still need a spark for that kind of outperformance. What was the specific Polkadot news?
That would be the second factor, network upgrade anticipation. Polkadot announced an upgrade for January 20th.
And what's special about this one?
It implements these key latency-reducing changes that they already, battle-tested on their canary network, Kusama. But the critical part is that these changes are designed to make it much faster and smoother to integrate with the existing Ethereum developer stack.
Ah, so it's about attracting builders. Less friction means more developers.
Exactly. And the market loves to front-run that kind of potential developer migration. So you see the price move on the anticipation.
Okay, so market momentum, developer anticipation, and I'm guessing the third factor was a technical signal for the traders.
Precisely. The third factor was a classic technical breakout. DOT pushed through and cleared a key 23.6% Fibonacci resistance level at $2.18. And it did it with significant bullish volume.
The green light.
It was the green light for traders. So the big question for them now is, can DOT hold that 218 level as support going forward?
Okay, that makes sense of the recent hype. Let's move to the bedrock of the project itself, the architecture. This whole system is built on this idea of shared security. Can you break down the fundamental components for us?
Sure. It all starts with the relay chain. You can think of it as the heart of the system. It's the primary blockchain, and its only real jobs are to dictate consensus and coordinate everything else.
Then provide that shared security.
And most importantly, provide that shared security guarantee to every single chain connected to it.
So what does that actually mean in practice? Can you give us an analogy?
Yeah, think of it like a high-security office park. Instead of 100 different companies, each hiring their own, sort of vulnerable security guard,
Right.
they all pool their money to hire the most elite, impenetrable security force in the world to guard the entire park. So if you want to attack Company A...
You don't just have to get past their front desk, you have to take on the entire elite force.
Exactly. For Polkadot, an attacker would have to spend enough money to overwhelm the security of the entire relay chain, this massive pool of staked DOT, just to try and revert a single transaction on one specialized little chain. It makes it prohibitively expensive.
That pooled security model is really powerful. Okay, so where do the specialized chains, the parachains, fit in?
So those are the parachains, which stands for parallel chains. These are fully independent layer 1 networks. You might have heard of some, like Moonbeam or Frequency, and they have complete autonomy. They set their own rules, their own fees, their own governance.
And they just plug into the relay chain for that security blanket.
That's the idea. They inherit the Fort Knox level security, but get to operate their specialized business in parallel without bogging down the main chain.
So how do all these different autonomous chains talk to each other without using those often vulnerable external bridges we hear about getting hacked all the time?
That is handled by something called XCMP cross-consensus message passing. It's Polkadot's own native language for secure data exchange, because every parachain is secured by the exact same consensus mechanism.
The relay chain.
Right, the relay chain. They can inherently trust messages sent via XCMP. This means bridging between chains takes like under a minute, and you completely remove that massive attack surface that centralized bridges represent.
That feels so much more robust. But I imagine securing a full parachain slot is, well, it's difficult and expensive, as we'll get into. Is there another way for a smaller project to tap into the system?
Yes, and that's a key part of the design. That's where parathreads come in. They're essentially parachains that use a flexible pay-as-you-go model.
So you don't need a full-time lease.
Exactly. If your app only needs a burst of activity, maybe it's a tool that runs once a quarter or an oracle that just pings data occasionally, you can pay for that connectivity dynamically. It's a much more economical on-ramp for projects that don't need constant high throughput.
Okay, so we've got this complex sharded system all secured by this massive security pool. How is this entire machine actually governed? And, what are the incentives for the people who are putting up the tokens to secure it?
It's secured by a mechanism called nominated proof of stake, or NPOS. It basically has two critical roles, validators and nominators.
Okay, what do they do?
Validators are the ones running the nodes, confirming transactions, proposing blocks, the heavy lifting. Nominators are any DOT holder who can choose to stake their tokens behind up to 16 validators that they trust to do a good job.
And what's in it for the nominators? Why take the risk?
They get a cut of the validator staking rewards. And the model is really clever. It's designed to push the network toward an ideal staking ratio of 50% of the total supply.
How does it do that?
If the total amount staked is below 50%, the rewards are higher, which incentivizes more people to stake. If it's above, they're a bit lower. Right now, with about 1.65 billion DOT circulating, the network is sitting right around that sweet spot at about 51.2%.
But with those rewards comes the risk, the nuclear option. If I nominate a validator and they go rogue, what happens?
That's the slashing risk.
Yeah.
It's brutal. If a validator misbehaves, gets caught being unresponsive, or even worse, trying to cheat the system, both the validator's stake and every single nominator's stake DOT gets slashed.
So you can lose your money.
You can lose a portion or potentially up to 100% for a really severe offense. This forces nominators to do their homework. They aren't passive investors, they're active risk managers.
And what if I just change my mind and want my capital back?
Well, there's a pretty significant liquidity constraint. If you decide to unstake your DOT, it stays locked for about 28 days on Polkadot. And during that whole unbonding period, you earn 0 rewards.
Ouch. So it really forces a long-term mindset.
It absolutely does. You have to be committed to the network's security.
Okay, so the network is secured, but it's also designed to be self-evolving, which brings us to its governance and this big transition to OpenGov and the Polkadot 2.0 roadmap.
Yeah, this is a huge deal for them. The network's leadership basically admitted their first governance model, V1, was too slow. It was too centralized, relying on these small groups like the council.
Right.
The move to OpenGov was a pretty radical shift. It completely eliminated those central bodies and pushed all decision-making power out to the public community. The system can now handle multiple proposals or referendums all at the same time.
If anyone can propose anything, how do you stop total chaos? Or how do you make sure a, super sensitive technical upgrade is treated differently than a simple request for some treasury funds?
They use a framework of origins and tracks. Think of an origin as like classifying the security level of a document.
Yeah.
A root origin proposal that could alter the core protocol is like a top-secret briefing.
So it goes through way more scrutiny.
Way more. It gets a much longer consideration period, a higher bar for approval. The tracks define that whole procedural flow. Meanwhile, a low-impact proposal, like a small treasury grant, can be fast-tracked. It's a system for managing priorities.
That's pretty clever. And I saw something in the notes about voters being able to signal their commitment. Conviction voting?
That's right. With conviction voting, if you really believe in a proposal, you can voluntarily lock up your DOT for a longer period of time when you vote. The longer you lock it, the more weight your vote carries. You're signaling you have real, long-term skin in the game.
Okay, looking forward then. What are the big headlines from this Polkadot 2.0 roadmap that have people excited?
It's all about scaling and making life easier for developers and users. The big conceptual leap is something called agile core time or elastic scaling. It's designed to dynamically scale the network and could potentially support over 1,000 parachains.
Wow, a tenfold increase from the current plan.
Potentially, yeah. And for users, they're working on fast unstaking, trying to get that painful 28-day lock period down to as little as 2 days when the network isn't too busy.
That would be a huge deal for liquidity.
A huge deal. And then there's the Polkadot virtual machine, the PVM, to let Ethereum code run seamlessly, and a proposal to use DOT as a universal fee token across every single chain in the ecosystem. Big, ambitious stuff.
All right, we've covered the impressive tech, the democratic vision of OpenGov, but now we have to face the cold economic reality that the sources bring up. When you look at the actual financial barriers to entry, they seem to completely contradict this goal of decentralization.
This is the central tension of the entire project. The technical design is brilliant, but the real-world economics, they impose a massive barrier. The network limits the number of active validators. Right now, it's only 297.
Okay.
And because these validators have to compete every single day for who has the most stake backing them to get into that active set, the minimum capital you need is just enormous.
How enormous are we talking?
According to academic data from back in April 2022, the minimum stake required just to have a shot at becoming an active validator was about 1.8 million DOT.
Wait, hang on. Stop there. Let's put a dollar figure on that. What was 1.8 million DOT worth at that time?
At that time, that was worth, get this, 32.4 million US dollars.
32 million just to participate in securing the network? That's not a technical hurdle. That is an exclusive financial moat. How can a project committed to open governance justify a barrier that high? It seems to restrict participation to, what, giant corporations and crypto whales?
That is the core conflict that critics hammer on. It creates this classic rich get richer dynamic. It concentrates the power to run the network and therefore the power to earn the rewards from running it in the hands of a very small number of entities. It directly challenges the whole decentralized ethos.
And it's not just the validator role that's the problem. The sources suggest even the little guy, the nominator, is getting squeezed out.
They really are. The data shows this pretty alarming trend with validator commissions. Over time, a majority of active validators, often more than 60% of them, set their commission rate to 100%.
100%. So let me get this straight. A validator charges a 100% commission, which means the nominators who are staking their own money and taking on all that slashing risk, they get exactly zero reward.
Precisely. It's a clear signal. It strongly suggests that these validators are just nominating themselves with their own other accounts to meet the minimum stake, effectively monopolizing all the rewards. It actively discourages small, honest community members from even trying to participate.
It's a structural disincentive. And what about on the other side? Building on Polkadot, is the financial barrier to secure a parachain slot just as bad?
It is. Polkadot has this hard cap right now of just 100 parachain slots, so they're incredibly scarce. And securing one in their competitive Campbell auctions means locking up tens of millions of DOT for a 2-year lease.
What did that cost in the early days?
Well, for context, in the very first batch of auctions, a winner like Moonbeam had to lock up 35 million DOT. At that time, that was worth $630 million.
So whether you want to be a validator, a nominator, or a project building a parachain, Polkadot's high-tech democratic system is filtered through this enormous structural economic barrier.
And that's really the whole picture. You have this incredibly sophisticated, technically advanced network. It has huge developer activity, nearly 9,000 active developers, which is second only to Solana by one metric.
So the tech is thriving.
The tech and the builders are there. Yet at the same time, it's facing these profound economic hurdles that seem to limit genuine, broad participation, especially for anyone new or small.
So you now hold the complete picture. You understand that Polkadot is this evolving layer zero powerhouse focused on shared security and governance, and it's experiencing this rapid market growth while at the same time grappling with these really deep systemic questions about who can actually afford to run the thing.
It's the ultimate battle between a democratic technical design and a harsh economic reality.
Right.
And that leaves you with a really important question to think about. given that the whole goal of OpenGov is to democratize decision-making. And yet, the minimum cost for a meaningful economic role, like being a validator, is prohibitively high. What other mechanisms, outside of just owning a ton of tokens, will ultimately prove most effective in making sure the network stays secure and is truly governed by its community? That's something to explore until our next deep dive.